Banks don't add covenants and conditions just to complicate a deal. They add them because they protect both the bank and the borrower from future risk. Hi everyone, I'm Sandeep, a business analyst working in wholesale credit. And in today's video, I'm breaking down a common but very misunderstood concept in commercial lending: covenants versus conditions. If you work in credit, risk, banking technology, or even if you're just curious about how lending works behind the scenes, this is a pretty foundational concept. First things first, what are conditions? Conditions are like entry requirements. Conditions are one time requirements that must be fulfilled before the bank disperses the loan or even at specific milestones. They're like a gate pass to the loan. Let me give you an example. Say before a customer or a borrower draws down, before a drawdown, the borrower must provide property insurance worth, say, $5 million. The borrower must submit audited financial statements for the last 3 years. This could be another condition. Or the bank may require a first charge or a lien to be registered before releasing any funds. This could be another condition. So once conditions like these are satisfied, they usually ticked off and then they don't continue throughout the life of the loan. So conditions are initial safeguards. Once fulfilled, they're not going to be done again. But what are covenants? Covenants are like ongoing promises. Covenants are continuous obligations that the borrower must adhere to throughout the loan term. They act as ongoing guardrails and early warning indicators for the bank. So there are two main types of covenants. One, financial covenants. Two, non-financial covenants. So let me give you an example of what a financial covenant is. Let's say a commercial real estate borrower must maintain a DSCR, a debt service coverage ratio of at least 1.25 times or 1.25x. More on DSCR in the next video. But say the borrower earns $1.25 million annually and their debt obligations are $1 million. Right now, they're compliant because it's 1.25 times. But if the income drops to $1.1 million, the covenant is breached. This is a clear warning signal for the bank to engage, to understand the issue, and take preventive action. Non-financial covenant examples: the borrower must submit quarterly financials within 45 days, or the borrower must inform the bank before taking an additional debt exceeding 500,000 US dollars. These covenants help the bank track behavioral and operational aspects of the borrower. So covenants are like long-term promises, and they're monitored continuously, and they can be both financial and non-financial covenants. So why do banks use covenants in the first place? Covenants aren't meant to restrict. They're designed to manage risk proactively. They help in early detection of financial stress, triggering timely conversations with the borrower, protecting loan quality, ensuring that the business remains stable enough to repay. In wholesale credit, covenants form the backbone of portfolio monitoring. For example, if a borrower's covenant breaches multiple times, what does the bank do? The bank may require additional collateral, they may increase the interest margin, they may restrict further borrowing, or the bank could even reassess the credit limits that they have given to this borrower. So, a quick summary of what we've discussed. Conditions are like one-time requirements before or during a drawdown. Covenants are like ongoing obligations during the life of the loan. It's like a promise to do or not to do something. So both covenants and conditions protect the borrower and the bank by keeping the loan within acceptable risk boundaries. Well, thank you so much for watching. This is Sandeep, business analyst in wholesale credit. And in my next video, I'll break down DSCR, debt service coverage ratio, the single most important ratio in commercial lending. See you in the next video.